Hello and welcome everybody. My guest today is Steve Brann, founding partner and CEO at Apollo Multi-Asset Management. We'll dig into what Apollo actually does, how the team is set up, and where they sit in the market, what truly differentiates their multi-asset strategy, and where liquid alternatives fit into a traditional 60-40 portfolio. A warm welcome to Steve Brann.
Thank you very much, Thomas. Glad to be here.
Steve, what truly sets Apollo's multi-strategy and absolute return approach apart?
So it's been a process that we have honed over several years. Originally, we were multi-asset investors, and over the last 8 years, we've developed our skills in absolute return investing. So we have a very strong, diverse portfolio of absolute return UCITS daily dealing funds. So we have concentrated on being able to build a portfolio that has very little correlation and delivers very strong, consistent returns with very low drawdowns. So we believe that our portfolios are probably more diverse than the average portfolio out there, and that enables us to have consistent returns over time.
For listeners who may not be fully familiar, could you give us a concise sketch of Apollo Multi-Asset Management, your mandate, your team setup, and where you sit in the market?
Well, we started in the eye of the storm in 2008, so interesting time to start the business. Originally, we were multi-asset investors, as I mentioned, but we always had a strong bias towards hedge funds and absolute return investing. And when we set the business up in 2008, the mandate and the mantra of the business was very much to deliver consistent returns for investors, while also thinking about downside risks and able to protect people on the long run. We're a boutique asset manager, 4 senior fund managers within the team, all of us with decades of experience. So I'm just about to get into my 40th year in the markets. So very experienced team across all of the different asset classes, but with a specific bias towards absolute return investing.
There are many absolute return and multi-strategy products out there in the market. So what concretely makes Apollo's approach stand out in terms of process, brief of strategies, and how you deliver outcomes across cycles?
I think the first thing that sets us apart is that many of us in the team have had direct experience investing in absolute return strategies. So we're not just fund-of-fund pickers, picking the best investment managers. We've all experienced at different levels direct investment. So it enables us to get under the bonnet of investment managers and really understand the process. But what we found that many people made a mistake in the industry was not having enough diversity in a portfolio. So we have divided our portfolio into 5 sub-strategies, which is event-driven, macro, long-short equity, market neutral, and bond and rate strategies. So we have a very, very diverse portfolio. And then we are looking to invest in the best managers within each of those subcategories. Each of our managers has some level of idiosyncratic risk, but also repeatable performance that helps deliver those returns in the long run.
In a classic professional portfolio, like a 60-40 portfolio, where do liquid alternatives belong today? From which sleeves are they typically funded, and what core versus satellite sizing ranges have proved resilient?
So I guess it depends, and there's various different research across the marketplace. At Apollo, our traditional multi-asset portfolios have had up to 30 to 40% in absolute return. But a lot of analysis that's coming from the marketplace currently would suggest closer to 20%. So JP Morgan do a very good guide to alternatives, and they show that if you add alternatives to traditional 60-40 portfolios, then you can increase your return profile while reducing risk. So they advocate for a 20% allocation. Just recently, in the last month, the BlackRock Institute have also advocated further. I mean, they're talking specifically about hedge funds. We're in the UCITS daily dealing space, but they're advocating increasing a further 5%. So they're in the 15 to 20. So empirical analysis by the industry is suggesting that sort of 15 to 20 is a good allocation to liquid alternatives. And in terms of the space, most people are probably taking some of the allocation away from the bond sectors. But the analysis from JP Morgan suggests that it works taking from equities and bonds. But traditionally, people see liquid alternatives and bonds in a similar sort of volatility risk space.
You emphasize low correlation and genuine diversification across strategies. So how do you build and monitor a portfolio that stays diversified when correlations rise? So what guardrails, data, and governance do you rely on in volatile markets?
I mean, for us, it's a combination of both qualitative and quantitative research. So from a quantitative point of view, put all the portfolios through risk management models and look at various different scenarios from the past to see how the portfolios may or may not perform. So we have a very diverse portfolio of, currently we've got 22 different fund managers, all with idiosyncratic risk, which helps to smooth out periods of volatility. And then there's the qualitative side that a risk management model may not be able to pick up when markets become more volatile. And that is the experience of interviewing fund managers, asking the questions of what black swan events may they have in their portfolio, what are their current outlooks, so that we can analyze all 22 holdings and look to see if there's going to be any potential correlations in various different scenarios. So it's a combination of both, and we've been really successful over the last 8 years of being able to develop a highly diverse portfolio, and it's at a bucket level, i.e. the sub strategies, but also at a fund manager level. They're all got slightly different exposures, factor risks, etc.
So you already mentioned the underlying managers, and manager selection sits at the very heart of your process. How do you source diligence and continuously assess underlying managers to ensure quality, independence of alpha, and alignment on capacity and risk?
So there are initial screens that we will put through to look at whether funds have had large drawdowns, what kind of return profile they have, what kind of correlations they have with various different markets. But it's a very rigorous interview process after that. So we will screen out a certain proportion of the marketplace that would not fit within our constraints, but then it's very much an interview process. And with our experience of having run the underlying strategies, we have a good understanding of what type of managers that we want in our portfolio, how they're going to react to difficult markets, how they're going to work within, bullish markets. And it's then blending lots of different managers together that, as I mentioned before, that have got lots of idiosyncratic risk. We're quite lucky in the marketplace that we've developed a relationship with, many asset managers across the universe, and lots of people come to us if they want to launch a new fund, seed a new fund, because we have a reputation of being able to help them in the early stages of their development of new funds. So there's lots of different sources, but it's this constant interviewing process. We speak to all of our managers on a monthly basis, asking them, how the portfolio is developing, what risks they have. So it's this constant monitoring, but also putting it through the risk management system to see if there are any red flags or any kind of issues that are being developed.
So this one is on risk management. So what are the key tools and principles you apply to keep volatility in drawdowns low? So position sizing, factor limits, scenario analysis, and where do you draw the line on complexity versus robustness?
In terms of, we have an internal risk management system, which is supplemented by the BlackRock Aladdin system, which is a fantastic system that we can plug all of our holdings in. They have a very deep dive access to many of the underlying strategies and the underlying positions. And we can run through the BlackRock system to be able to highlight various different risk factors, whether that is drawdown, whether that's correlation, whether it's factor risk. And so we're trying to neutralize as much of any kind of factor risk in our portfolios, any kind of correlations between managers. They provide a very detailed report where we can run scenarios to see if there was a rerun of the 2008 crisis, if there's a rerun of COVID, if there's a rerun of an inflation spike, what would be the predicted performance of the portfolio through each of those scenarios. Now, risk management models are just a tool and they're never 100% correct. So that's where the skills that we have as managers is to overlay what the risk management system will give us and then add our interview process. And we will get different answers from managers than necessarily the risk management system. So just one question we finish every meeting with is, what's a black swan event for your strategy? And if we have 5 managers saying Middle East war or inflation spike or COVID Mark II, we know that we've got too much correlation. So it's a very simple question, but the way that people answer that is really important. And it's deep in our thinking in terms of making sure that we don't have those kind of correlations and risks in difficult markets.
Very interesting probing question. So under a usage structure, how does the framework shape your investable strategy set? You mentioned macro event-driven, long-short equity, market-neutral, liquid credit rates. Which concrete safeguards keep liquidity mismatches at bay during stress?
So I think, ultimately, UCITS liquid alternatives or absolute return strategies essentially are a derivative of hedge funds. But UCITS structure is such a great space for anybody who wants a return profile that is around about I think the sweet spot is somewhere between cash plus 2 to cash plus 5 for UCITS. If you want higher returns, more volatility, you really need to go into the hedge fund space. So what UCITS provides is a fantastic framework for which we can operate, or our underlying fund managers can operate. So there's limited gearing that can be put into a UCITS portfolio. There's diversification rules that go into UCITS. And so this provides us with, and then there's extra risk management that they all have to go through to comply with the UCITS rules. So this gives us a much more stable environment to invest in than in hedge funds that tend to be a little bit more opaque, to be able to have daily liquidity. So everything that we invest in is daily liquid. So I believe over the last 25 years since UCITS absolute return funds have been in existence, we've only ever had one that's got in trouble, which was an H2O fund, and there was a little bit of fraud there. But compared to the hedge fund industry, where there are blow-ups and frauds on a regular basis, it really doesn't exist in the UCITS space. So there's great frameworks and guardrails that are put in place by the structure. And then obviously there's the guardrails that we're then interviewing people and looking at the complexities of what they do. And basically we have a rule: if somebody invests in something that we don't understand, we don't touch it. It's very key that you totally understand all of the strategies, how they are deriving their returns and how they're deriving their risks. And hopefully, because of our experience of running those positions, we understand it, very, very well. So we use all of those different factors.
For a cash plus target with controlled drawdowns, what is the appropriate benchmark and evaluation horizon for diversified multi-strategy UCITS? And which metrics, volatility, max drawdown, correlation, should allocators prioritize?
I mean, the benchmarks that we look at is a cash plus. So we're looking at cash plus 3. We've achieved cash plus 4 over the 8 years. So that's our primary benchmark, is that within that 3 to 5 a year investment horizon, we are looking to compound returns at 3 to 5%. Alternative benchmarks that we compare ourselves against as well is really within the hedge fund industry. So we look over to the US and we look at the US fund of funds industry, but also look at the US multi-strategy industry, and we've compared very favorably over the years. So those are the primary sort of benchmarks that we will look at. It is designed to be a cash plus vehicle. In terms of metrics, the key ones for us, sometimes we say we're all the threes. We're cash plus 3 with a volatility of less than 3 and a max monthly drawdown of 3. So they're kind of 3 parameters that we can consider. But then the other metrics I think people should look at is our Sharpe ratio. So we have a very positive Sharpe over 1. So historically at the moment, over the last 8 years, it's been a 1.4 Sharpe ratio, which is pretty good. We like to talk about our positive smile. So the smile that we describe is the number of positive months we have compared to negative months. So we have a very strong positive smile, around about 80% positive months to negative months. So, compared to the equity market, compared to bond markets, that's very positive. And then when we look at our correlations, we actually have a negative correlation to the bond market, which is very positive when you add that into a portfolio. And we have a very mild, like almost negligible correlation to equities. So we're not really correlated, and hence why it fits so well against your traditional assets when you add it into a multi-asset portfolio.
My thanks to Steve Brann of Apollo Multi-Asset Management for the candid insights on what makes their process different and how to place liquid alternatives in a modern portfolio. Thank you for listening and see you next time.
Thank you very much, Thomas.